and I'll see if I can figure out how to get this thing working permanently. All right, so good, happy Wednesday. So hopefully you got a chance to take a look at the lecture for chapter 2, because chapter 2 is where we really start getting into the nuts and bolts of how to do accounting. Let me just check one thing here real quick before we get started. So it looked like when I checked last night, it looked like a couple people have gotten onto my business course, gotten set up. Let me check and see what it looks like today. So we still got a couple people. So if you haven't done so, first order of business is to get access to my business course and get an account, because the first assignment for chapter 2 is going to go live today after class. It's going to be due Sunday night at 11:59 p.m. Pacific. So if you don't have an account, I see 2 people have got accounts so far. So if you don't have one, get access to it and get an account on my business course so we can get going. You know, the pace of summer classes moves pretty quickly. So I've got to start doing assignments here right away. So let's see if I think that's it. Any questions come up about chapter 2? I'm going to go over a couple of things that people typically have some trouble with in chapter 2, and we'll take a look at some problems.
I had a quick question. So I signed or enrolled for last summer's my business course. How would I switch?
So you probably will have to email or use the support and just explain. I think people have done that before, and they should be able to switch over. Just there's the support tab at the top. Just click on that and send them a message. And on weekdays, they're pretty quick about responding.
Okay, perfect.
So,
thank you.
Okay, not sure why. Let me make sure. Let me see if I can. Summer 2021. Let me fix this so that doesn't happen again. Not sure why you were able to register for it. It shouldn't have allowed you to register. But anyway, yeah, they should be able to take care of that with support. Okay, let me do one other thing here before I get started. Let me just pull the textbook up. So I've got that ready to go. All right, so chapter 2 goes through the mechanics of how we do financial accounting. So remember the big picture of what we're trying to do. We are trying to look at events that happen to a business. Things have changed with the business, and we're trying to figure out, is there a financial impact on the business? In other words, will there be money flowing? You know, something changed with the assets, liabilities, or equity of the business. And if it has, we need to record that, translate whatever has happened into dollars and cents, and record that change in dollars and cents on our financial records. So first thing that I wanted to take a look at, because typically it gives people trouble, is the concept of debiting and crediting. So debiting and crediting to increase and decrease accounts. So let me pull up the notes and take a look at this real quick. So debits and credits are just a way to make things get bigger and smaller. That's all they are. People often get confused with debits and credits because people kind of try to find a way to think about them, is that they're good or bad, they increase or decrease. And the thing that's confusing about debits and credits is they're not consistent. Depending on what accounts you're dealing with and what you're trying to accomplish, sometimes we need to debit things, sometimes we need to credit things. So debits and credits it's a system that's been around since the 1400s. It's withstood the test of time. And it's a system that was developed to kind of put everything together into one big system to keep track of accounts for a business. So an account is just something that we want to keep track of: how much cash we have, how much accounts receivable we have, which is how much our customers owe us, how much accounts payable we have, how much we owe to our vendors. So there are things that we need to keep track of. And debits and credits are a system of making those accounts bigger or smaller when a transaction takes place. So this first slide shows you the only thing that's consistent about debits and credits. Debits always involve making entries on the left side of a T account. T accounts are these things on the slide that we show for all the different accounts. And when you're doing something to the left side of the T, you're debiting the T account. When you're doing something to the right side, you're crediting the T account. Whether a debit makes the account bigger or smaller, or whether a credit makes an account bigger or smaller, depends on what account we're dealing with. And this table is a good summary of the general rules. So assets are made bigger when they're debited. And see how it says normal next to the account? The normal balance is what the account normally has, assuming it has a positive balance. So if we're dealing with cash, which is an asset, if we have a positive balance in our bank account, that would be reflected with a debit balance. If we've got a bank account that we're overdrawn on, that has a negative balance, that would be reflected as a credit balance for an asset. And the way the rules work for debits and credits, whatever the normal balance is, to make an account bigger, you do the normal balance thing. If you want to make it get smaller, you do the opposite. So assets are made bigger with debits, assets are made smaller with credits. Two other things behave like assets. Expenses behave the same way. Normal balance there is a debit balance. They're made bigger when they're debited, smaller when they're credited. And the third thing that behaves like that is retained earnings. Or not retained earnings, excuse me, dividends. I was looking at the retained earnings account as I was speaking, dividends. So three things normally have a debit balance: assets, expenses, and dividends. And then three things normally have a credit balance as a normal balance: liabilities, the equity accounts, which include common stock and retained earnings, and then revenues. So the key to debiting and crediting is remembering what's the normal balance for this type of account. If I want to make that account bigger, then I do whatever the normal balance is. If I want to make the account smaller, I do the opposite. So assets, because they're, or cash because it's an asset, gets bigger with a debit. Accounts payable, because it's a liability, gets bigger with a credit. So I think that's the thing that throws people for a loop with debiting and crediting, is it's not consistent. Sometimes you debit things to make them bigger, sometimes you credit things. And the other thing, the other common mistake people make is that they want to classify debits or credits as being good or bad. You know, when something good happens, we do one thing. If something bad happens, we do the other thing. And that doesn't even work, because assets are good things, things we own. When we own more things, we debit them to make them bigger. Revenue is also a good thing. When you sell things to a customer, that's a good thing for the business. Revenues are made bigger with credits. So don't think about debits and credits in terms of good or bad. It's just a mechanical system with a set of rules you have to memorize. And if you can memorize the rules, then debits and credits become not so painful after you get some experience with them. So the key to doing debits and credits is just remembering what the normal balance is. Three things normally have a debit balance. Three things normally have a credit balance. So your thought process when you're learning to do this stuff should be, number one, think about what type of account is this? Is it an expense? Is it equity? Is it an asset? And once you have it straight in your head, what kind of account it is, then move on to thinking about, do I need to debit the account or do I need to credit the account? Don't think about it in terms of this thing is getting bigger, therefore it must involve a debit, because that's going to be true for some accounts, but it's not going to be true for all the accounts. Okay, does that sort of make sense? The way you get good at doing this is just to practice it. We'll go through some problems today where I'll go through and show you a bunch of examples of this, but you're just going to have to sit down and do some problems where you do this, and there's going to be some, pain and suffering involved as you learn this. The learning curve on this in the beginning is pretty steep. It can be frustrating. It doesn't seem like it makes sense, but there really is a method to the madness. There is a system behind what we're doing, so we can You'll get good at it after you do some practice some of them. Okay, so that is the basics of debiting and crediting. Second thing with debits and credits, when we start recording things with debits and credits, when you're done deciding what's getting debited and what's getting credited, when you add up all the debits and you add up all the credits, the dollar amounts of each, they've got to be equal. If the totals are not equal, stop and think some more, because you're going to make a mistake that's going to mess stuff up down the road, and then you're going to tear your hair out trying to figure out why something else doesn't work. So total of your debits, total of your credits on each transaction have to be equal, and there has to be at least one debit and one credit. You can have more than one of each, but there has to be at least one. So make sure those rules are satisfied when we record transactions. Okay, so the way that we're going to record transactions, and we'll see plenty of this today when I go through examples, is we're going to use journal entries to record the transaction initially. Journal entries are just a record of all the transactions a business has had. For this particular transaction, we're debiting cash, and then the notation or the way to do debits and credits when you do journal entries, debits are always listed first. So any account that gets debited, we list it out, and we put the dollar amount that we're debiting the account in the debit column. Once we're done with all of our debits, then we move on to the credits. The account name for credits is indented to make it obvious that the account is being credited, and the dollar amount for the credit goes into the credit column. So this would be a journal entry. Anybody know what this journal, well, it tells you issued stock for cash. So what's happening here is this business raised capital. They sold some ownership in the company in the form of common stock, and they got some cash for it, $30,000. So remember our rule. We've got 3 accounts. We've got 2 accounts. We've got cash, we've got common stock. What kind of account is cash? Asset, liability, equity, revenue, expense, or dividend? Which category does cash fit into? It's an asset. And what's the normal balance for an asset? We'll go back and look at our cheat sheet. Assets normally have a debit balance. So if a business receives cash, the cash balance needs to be increased. Cash is an asset which normally has a debit balance. Therefore, we need to debit cash to make it get bigger. The other thing is we've got common stock. We have issued common stock to shareholders. The way common stock account works is when you sell shares of stock, common stock gets bigger. When you buy the shares back, common stock gets smaller. So given that we've issued shares of stock, we need to increase common stock. What kind of account is common stock? Which of the 6 categories does common stock fit into?
Would it be equity?
It would be equity, and equity normally has a credit balance. So to make an equity account bigger, we need to credit it. So the journal entry to record the receipt of cash in exchange for stock that we've issued to stockholders. We need to increase cash, so we debit cash. We need to increase common stock, so we credit common stock. So that's the thought process. That's how to approach these problems when you do them. Think about the accounts. Is the account, what accounts are involved? Number 1. Number 2, is the account getting bigger or smaller as a result of the transaction? And then number 3, and wait until number 3 before you start doing it, then start worrying about debits and credits. Based on the accounts, does the account need to be debited or credited based on the type of account and based on whether the account needs to be made bigger or smaller? Okay, so we're going to use debits and credits 2 places. Number 1, we're going to use them when we record the journal entry. Number 2, the journal entry, once it's been made, we need to record that in a second place. We need to post that to the account. And we're going to use these things called T accounts to represent the accounts. And T accounts just mirror what we're doing with the journal entry. So we've got our cash T account. We debited cash in the journal entry. So we debit cash in the T account. Remember, debits are on the left, credits are on the right. So we're going to debit cash 30,000. And then the common stock T account, we're going to do the same thing we did in the journal entry. We're going to credit common stock for 30,000. So the purpose of these T accounts is after a while, we're going to have a bunch of transactions for some of these accounts. We need to figure out in the end what the balance of the account is. So the purpose of the T account is to keep track of all the debits and credits that have been made. And then at the end of the accounting period, we can figure out how much cash do we have when all is said and done. So they serve similar but different purposes. It's somewhat repetitive. You're just doing the same thing in a different place, but we're doing it in a different format that allows us to easily total up what the account balance is. Okay, and then final thing, the trial balance, once we're done with all the transactions being recorded, we list out all of our account balances. So what we would do is we go to each of our T accounts and we would total them up, see what the balance is, and then we transfer the balance from the T account and we would take that to the trial balance. And I'll do a problem here in a few minutes where we do that. So I'll go through the mechanics of how that actually happens. Okay, so questions about anything before we start looking at some problems? Anything that didn't make sense with debits and credits, journal entries, T accounts, anything that was in the chapter? Okay, well, let's take a look then at a few problems. So let's go to, I'm going to do one out of chapter 1. We'll pick up one problem from chapter 1. It's a good introduction to what we're going to do in chapter 2. I'm going to look at exercise 1-11A. Okay, so 111A, got a guy named Fred Flores who operates a golf driving range. For each of the following items related to his business, indicate the financial statement or statements in which the item would be reported. The balance sheet we'll call BS, income statement IS, statement of stockholders' equity, or the statement of cash flows. So one of the challenges, you have to learn a lot of stuff early on in an accounting class. In order to record transactions, we need to know whether something is an asset, liability, equity, revenue, expense, or dividend. So get a little bit of practice doing that with this problem. So I've got a list of items here from the problem. I just put those items on my spreadsheet so I don't have to flip back and forth. And we get a little practice on classifying different accounts, what kind of account they are and where they belong. Okay, so first account, accounts receivable. First of all, what's accounts receivable? This is a term you'll be hearing regularly in this class this semester. What is it? What are accounts receivable?
Cash?
Could be, hopefully they become cash, but they're not cash yet. It's
money that you get from the bank.
close. Money you get from your customers. It's money your customers owe you. So an account receivable comes about because a customer has bought something from you on credit. So customers bought something from you. They promised to pay you in the future, but they have not yet done so.
Prepaid?
Prepaids are actually the opposite. Prepaids are when you pay for something before you get it. So an account receivable is you buy something, a customer's bought something from you and they owe you money for it. So they give you 30 days to pay and they have yet to pay you. So what kind of account is accounts receivable? Asset, liability, equity, revenue, expense, or dividend? What do we think?
Is it revenue?
It's related to revenue. We'll see that when we get to transactions with accounts receivable, the other half of the transaction is going to be revenue. We're gonna record account receivable and revenue at the same time, but they're not the same thing. Revenue means we've made a sale, and account receivable means that the customer has yet to pay us for whatever they purchased from us.
So asset.
It's an asset, because assets, the definition of an asset is something that we own that gives us future benefit. And accounts receivable meet that definition. We own the right to collect money from somebody, and them providing us with cash in the future is a future benefit. So accounts receivable would be an asset. So with that in mind, where do you find assets? On the balance sheet, the income statement, statement of stockholders' equity, or statement of cash flows?
Balance sheet?
It'd be on the balance sheet. So if we want to find accounts receivable, we'd find them on the balance sheet in the assets section. Okay, what about cash received from the sale of land? Where do we find cash, or what kind of account is cash? Asset, liability, equity, revenue, expense, or dividend?
Asset.
That's also an asset. So given that it's an asset, we would find it in the same place that we found our accounts receivable. This one actually shows up in a second place. Any guesses where you might find this one besides the balance sheet? Remember, we said that these financial statements are interconnected, and stuff you see in one place sometimes shows up in another place as well. This one, not so obvious on that one, but this one, in addition to being the balance sheet, this one also shows up on the statement of cash flows. Remember, we said there's 3 sections on the statement of cash flows: operating, investing, and financing. That would show up in the investing section as a cash flow on the statement of cash flows. All right, net income. Where would you find net income? Net income is not really an account. It's a combination of, it's a kind of a byproduct of combining a bunch of accounts together.
Income statement?
It would be on the income statement, hence the name. It is the final product on the income statement. It's numbered down at the bottom. When you take all the revenues, subtract all the expenses, you are left with net income. Cash invested in the business by Flores, who's the owner of the business. Where do we find money that's been invested by the owner of the business? Well, I guess let me back up before I ask that question. What kind of account, what do we call money invested in the business by the owner? Is that an asset? Is it a liability? Is it equity? Is it revenue? Is it an expense? Is it dividends?
Equity?
It'd be an equity. So it's in equity, and where do we find stockholders' equity? Which financial statement has equity on it?
Statement of stockholders' equity.
Yeah, it'd be in stockholders' equity, and what financial statement shows us stockholders' equity?
Stock common?
I'm sorry?
Stock common?
It would be common stock,
Oh,
which is a part of stockholders' equity, but which financial statement has stockholders' equity in it? The balance sheet, the income statement, statement of cash flows, or statement of stockholders' equity?
Balance sheet.
Yeah, the balance sheet, and, as the name implies, the statement of stockholders' equity is also going to have, will also show the amount invested in the business by an owner. All right, notes payable. Notes payable means that you have borrowed money from somebody, often a bank, but not necessarily. So what kind of account is notes payable? Is it an asset, a liability, equity, revenue, expense, or dividend?
Equity?
Not going to be equity. Equity is when people buy ownership in the business, and borrowing money doesn't give people ownership in the business.
Is it a liability?
It is a liability. Anytime you see the word payable, some things are consistent in accounting, and this is one of them. Anytime you see the word payable attached to an account, you can safely assume it's a liability. Which financial statements do we find liabilities on?
Balance sheet.
Those would be on the balance sheet. So notes payable would be a liability on the balance sheet. Supplies expense. That one's kind of a giveaway. What kind of account do we have there? By the name, you can probably guess that's an expense, which again, a lot of times things will have the word expense attached to them, which is helpful. But as we'll see, sometimes you'll see things called prepaid expenses, and those are not expenses despite the name. So that one's not quite as consistent as the payables. Where do we find expenses like supplies expense?
Balance sheet.
Wouldn't be on the balance sheet. Balance sheet's only got assets, liabilities, and equity.
Equity.
Well, supplies expense will affect equity eventually, but you wouldn't see supplies expense listed in the equity section on a balance sheet. Where do we find expenses?
Income statement?
They'd be on the income statement. Land. What kind of account is land for a business?
Asset.
That is an asset. And you know what, I'm just realizing I must have made a mistake here when I did my supplies. Okay. As I suspected. So land is an asset. Where do we find assets?
Balance sheet.
On the balance sheet. Okay, now just to make things confusing for you, we're going to see the return of supplies, but it just says supplies rather than supplies expense. Autofill got me there on Excel. What kind of account are supplies? Supplies are things like copier paper and pens and pencils and cleaning supplies. It could be a variety of things, but they're miscellaneous things that get used up in the course of running the business. What kind of account are supplies?
Is it like equipment? So an asset?
It's an asset. And the distinction here between what's a supply and what's supplies expense, supplies represent things that you still have that have not been used up yet. Therefore, they're an asset. Once they do get used up, they become supplies expense. And this is a pattern we're going to see a lot during the semester. Often, not always, but often as assets get used up, they get converted into an expense. So when supplies get used up, they turn into supplies expense. So a pattern we will see many times before we're done this semester. Okay, so a little bit of an introduction there. And I was going to show you I was going to take a quick look at the financial. Did we take a quick look at the financial statements for Amazon today too? So you saw some, abbreviated versions when we went through chapter 1, and then in the notes for chapter 1, or in chapter 1 itself. So let me show you what a real set of financial statements looks like. So here are the financial statements for Amazon. So Amazon, let me skip past statement of cash flows. For some reason, they list that one first. That's actually unusual. Companies usually don't list that one first. Let's focus in on the balance sheet and the income statement for now. So the income statement, like I said on Monday, companies will often call the income statement a statement of operations, different name for the same thing. So what an income statement basically does, it shows you two main things of a business. It shows you their revenues, which represent how much they've sold to their customers, and it shows you the expenses, the cost of running the business. So we've got 3 years worth of income statements for Amazon. The most recent one is on the right. Be careful when you look at financial statements. That's not always true. Sometimes companies will put the most recent year on the left. Sometimes companies put the most recent year on the right. Amazon's gone with the right. So this is the year ended December 31st, 2020. And Amazon benefited from the pandemic like few other companies did. Remember that when you look at a financial statement for a big company, the number you see is a truncated version of how much they actually have. Amazon does things in millions, so that means you need to add 6 zeros onto the end of all these numbers. So in 2020, Amazon sold $386 billion of stuff in 2020. Which is a more than $100 billion increase from the year before. So Amazon had a blockbuster year during the pandemic, which makes sense if you think about it. Everybody's stuck at home. Don't want to go to the stores. Want to stay home rather than go to a store. So jump on your computer and order it from Amazon. So Amazon sold $386 billion of stuff. Some of Amazon's stuff comes from the stuff that are for sales of products, which is the obvious side that most people interact with. The thing that a lot of people don't know about Amazon is that they have a huge service side as well. They have, like Amazon Prime streaming, but the thing that most of the service sales come from Amazon is AWS, Amazon Web Services. A lot of the stuff you look at on the web runs on Amazon servers. They're selling people server capacity. And Amazon makes an enormous amount of money with AWS. So total amount of sales, 215 billion of their sales came from product, 170 billion comes from selling services. Then down below that, we've got all of the expenses that are associated with running Amazon. Cost of sales represents cost of the products and services that are being delivered. Fulfillment, technology, marketing, administrative expenses. When we add them all up, Amazon spent 363 billion. So they sold a lot of stuff, but they also incurred a lot of expenses. So when we boil it down, what they made from operating their business before tax was just under $23 billion. Then we've got some other income and expenses that increase and decrease income. We've got some interest income, interest expense. Interest income is money they make off investments. Interest expense is money they've paid to borrow money from third parties. And then other, not exactly sure what that is. But the bottom line is before taxes, Amazon made 24 billion. They have a income tax provision of just under $3 billion. And on an after-tax basis, Amazon managed to bring home $21 billion in income. So I don't know if any of you pay attention to the stock market or not, but Amazon stock had a stellar year commensurate with the big increase in sales and big increase in profits that they had. Wish I had bought some Amazon at the beginning of the pandemic. I would be a very happy person. So if you look at Amazon stock, let's look at them over the last year. They had actually far enough into this year, but you can see during 2020, they started the year at, started the year at about 1,800 per share. They ended the year at about 3,200. So nearly doubled over the course of the year. So a fantastic year by anybody's standards. Okay, so the income statement shows what a company has done for the year in terms of revenues and expenses. The other thing that we're going to focus on early on in the course is the balance sheet, what they own, what they owe, and what's left over for the shareholders. So Amazon's got a pretty typical balance sheet. They've got some cash. They have marketable securities, which are places that you park excess cash to earn a return on the money, sitting there until you need it. They've got some inventory. That's merchandise that they own that's ready to be sold to customers. They have accounts receivable, which we talked about a few minutes ago. That's money owed to them by customers. Property and equipment, all those gigantic warehouses they've built in recent years all over the Central Valley. I don't know if you've ever seen any of these. They've got some absolutely enormous warehouses in Tracy and Patterson. And they actually built one out at the Stockton Airport too. I haven't actually seen that one, but I know they built one out there recently. Leases, goodwill. But in total, if you add up everything Amazon owns, shows up to be $321 billion of assets. What does Amazon owe to third parties? Accounts payable is what they owe to vendors. Accrued expenses, those are things like utility bills, things like that, taxes potentially. Unearned revenue, they've got some leases, they've got some debt, they've got other long-term liabilities. They don't give us a total for their liabilities, but let me eyeball this and I can tell you what it is roughly. Roughly, they have about $230 billion of liabilities. So they owe about $230 billion to third parties, which leaves stockholders' equity, what belongs to the shareholders of the company, is about $93 billion. So they own 321, they owe 230, and that leaves 90 billion more or less for the shareholders. And remember that this thing is called a balance sheet. Remember the accounting equation. Assets are equal to the total of liabilities plus equity. So pretty typical looking balance sheet for a business. I mean, a very big business, but these are the typical things you see on a company's balance sheet in terms of assets, liability, and equity. Any questions about Amazon's income statement or balance sheet? Anything here that looks interesting or doesn't make sense? So a wildly successful business by anybody's definition. Okay, well, let's take a look at some problems then from chapter 2. Let's take a look at exercise 210A. Oops. So a little bit of an extension of what we were doing in chapter 1 with the debit and credit rules. So we've got a list of accounts. And if we needed to change any of these accounts, we would have to apply the debit and credit rules to them and figure out if I need to make this thing bigger, would I debit or credit it? If I needed to make it smaller, would I debit or credit it? So we've got 8 different accounts, and we are going to say, which category does it fit into? Is it a normal debit balance account or is it a normal credit balance account? So like I did with the last one, I've got the information from the problem listed over here. And I'll just put the increased in because obviously if you increase it with a debit, then it's going to be decreased with a credit. So the first one is accounts receivable. So let's go, tell you what, before we actually start doing these, let's list these out. And then we'll have this to refer to as we go through. So what are the 3 types of accounts that normally have a debit balance? 3 kinds of accounts normally have a debit balance, which means they're increased with a debit. What are the 3 things that fit into this category?
Asset, expense, and dividend.
Assets, expenses, and debits are all normally have a debit balance. What are the 3 that normally have a credit balance?
Liabilities,
Liabilities,
common stock,
Common stock, but we'll make that a little broader and we'll say equity. Common stock is one type of equity.
Oh yeah, equity. Yeah.
Equity, and then what's
Revenues.
the last one? Revenue. Okay, so we'll have that to refer to. So accounts receivable. What kind of account is account receivable?
Debit.
It's normally has a debit balance because what kind of account is accounts receivable?
Asset.
It's an asset. So assets are increased with debits. Advertising revenue, again, sometimes these give themselves away. We see advertising revenue and have to be careful. There's one kind of revenue account that we'll talk about later that is not actually revenue despite having the name revenue in its account title. But in general, if it says revenue, it's going to be revenue. So revenues, if we look down at our rules, the normal balance for revenue is a credit balance. So to make a revenue account bigger, we need to credit it. What kind of account is building? Company's got a building that they operate out of. What kind of account is the building account?
Asset.
It'd be an asset. Something we own that gives us benefit, which is would as the building would fall into that category. What about common stock? What kind of account is common stock?
Equity.
It's going to be equity. So equity, we look down and we see that equity is increased with a credit. Should have written asset there. I should have written debit. What about notes payable? What kind of account is notes payable?
Liabilities.
That is a liability. And if we look down at our chart, we see that liabilities are made bigger with credits. What about retained earnings? Where do you find retained earnings? What kind of account is that?
Equity.
That is an equity account. So we see that equity accounts are made bigger when they're credited. What about supplies?
Asset.
That's an asset. So we need to debit that to make that bigger. And last but not least, we've got another one that's a giveaway, utilities expense. Again, you have to be a little careful here because there's an account called prepaid expenses that are not an expense despite the name, but utilities expense are in fact an expense. So we know that expenses are increased with debits. Okay, so those are some common accounts we'll be working with regularly, and those are the categories they fit into. All right, so let's look at another problem where we start doing some debiting and crediting. Let's take a look at exercise 2.2a. So with 2.2a, we have some transactions, and we need to identify the accounts that are going to be changed by the transaction, and we need to figure out if the account needs to be debited or credited as a result of the transaction. So we've got 1, 2, 3, 4, 5, 6, 7, 8, 9 transactions, and we need to figure out what's happening. Are we debiting or crediting the accounts, or the accounts getting bigger, or the accounts getting smaller? So we're really doing 2 in 1. We're going to analyze the transaction to figure out what it is, and then we're going to figure out if the account is debited or credited. Okay, so let me get my lettering off here somewhere. Oh, hey, they gave you. So as an example, so we purchased a desktop computer. We paid for it with cash. We're going to use it in the office. So the way to approach these is, number one, identify the accounts that are changed as a result of the transaction. And if you read this one's fairly straightforward because it tells us we used cash to buy a computer. So cash is going to be changed as a result of the transaction. And we've acquired a desktop computer, which would be classified as equipment. So cash is going to change, equipment's going to change. Are the accounts getting bigger or smaller? Well, we're using cash to buy something, so we're going to write a check. So cash is going to go down as a result of writing a check. So we need to decrease cash. And at the same time, we're acquiring a computer, so equipment needs to be made bigger. We've acquired equipment we didn't have before. So we need to make cash smaller. We need to make equipment bigger. And I'm going to take this a step further in this problem. We'll start getting some practice with debits and credits. So we need to make cash smaller. How do you make cash smaller? Do we debit cash to make it smaller, or do we credit cash to make it smaller?
Credit.
Debit.
We're going to credit it, because remember our last problem? Cash is an asset, normally has a debit balance. So to make something, an account that normally has a debit balance smaller, we need to do the opposite, which would be a credit. So it would involve a credit to cash. And then equipment is also an asset, needs to be made bigger. We know that assets are made bigger when you debit them. So we would debit equipment. So this transaction would involve debiting equipment to make it bigger, and it would involve crediting cash to make cash smaller. Okay, so let's go through and do this for 8 other examples. First one, we rendered services to a customer. Rendered services just means we provided services to a customer. Maybe we're a law firm and we did legal work for them. So we rendered service to a customer and we billed the client. So the client promised to pay us later. So the first thing is to identify what accounts are involved. So when we sell something to a customer, whether it be a service or a product, what does a business have when they sell a product or service to a customer? What do we call that?
Revenue?
That's revenue, because remember, that's what Amazon is doing. They get revenue from selling both products and services to customers. When you sell something to a customer, and it doesn't matter whether they pay you on the spot or not, whether they pay you now or pay you later, it's still revenue. So at the point at which the services are delivered or the goods are provided, we record revenue. What's the other half of the transaction? There's always at least 2 accounts involved. One account in this case is going to be service revenue. What is going to be, what's the other half of the transaction? What do we record when a customer promises to pay us later?
Is that accounts receivable?
That is accounts receivable. So we've got revenue, we've got accounts receivable. Is revenue being increased or decreased? When we sell something to a customer, do we have more revenue or less revenue?
Decrease.
It's actually going to be increased. When we sell something to a customer and we get revenue, we need to increase service revenue. What's happening to our accounts receivable when customer promises to pay us later? Are the accounts receivable getting bigger or smaller?
Bigger.
It's going to be bigger. So we've got 2 accounts getting bigger here. Service revenue is getting bigger and accounts receivable is getting bigger. So another thing people get confused on sometimes, it's because there's a lot of symmetry in accounting. If one thing goes up, another thing goes down. We don't always have to have an increase and a decrease with a transaction. We can increase 2 things, or we can decrease 2 things, or we can increase and decrease. So that one you can't, it's not going to be one of both always. So the journal entry that we're going to make, what do we do to accounts receivable to make it bigger? What kind of account is accounts receivable? Asset, liability, equity, revenue, or expense?
Asset.
To be an asset. So how do we make assets get bigger?
Debit.
We debit them. So an abbreviation I'm going to start making to save some typing. Accounts receivable are universally known in accounting as AR. So I'm just going to start calling accounts receivable AR. So accounts receivable, we don't have dollar amounts in this problem, so I'll just use X's. Accounts receivable would be debited for the amount of the sale. And service revenue also needs to be made bigger. How do we make revenues get bigger? Let's go back to our last problem. What do we do to make revenues get bigger?
Credit.
We need to credit them. So we would credit service revenue for whatever the amount of the sale was. So the journal entry to record this transaction would look like this. We would debit. The first thing we would do is we would record the debit to accounts receivable because debits are listed first. We would put the amount of the debit in the column where we show debits. So debits have a column and credits have a column. So the dollar amount for the debit would go in the debit column. And then we list out the credit for service revenue, and the dollar amount for the credit goes in the credit column. Okay, so transaction number one. Okay, transaction number two. We paid rent for the month. So what accounts are going to be involved in paying rent?
Asset.
So be an asset. Which asset specifically?
Prepaid.
Wouldn't be prepaid because we're not paying in advance. If we were paying rent in advance, then we would, if we're paying, like say if we're paying rent for the next year, then we'd have a prepaid rent, but we're not here. We're just paying for the current month.
Cash.
Cash. Cash is going to be involved. And the other half of the transaction is probably a little more difficult. Any guesses what the other half of the transaction is? Well, the way this works, so when you pay for something, the other half of the transaction is going to be one of two things. So when you write a check to pay for something, you're going to have cash as half of the transaction. The other half is either going to be an asset or an expense. And the way we determine if we need to make an entry to an asset account or an expense account is to look and see, is the thing we're paying for something that we're going to use in the future? If that's the case, then we're going to record an asset. If the thing that we're paying for has either already been used up or will be used up very quickly, then it's an expense. So given that we're paying for rent for the current month, are we going to record an asset or an expense?
An asset?
Well, for the current month, it'd be considered, pretty near future. So we'd actually record that as an expense. You could probably make an argument for recording it as an asset, but if you record it as an asset, it's more work down the road. And most people are inherently pretty lazy. So if we were just paying rent for the current month, we'd record it as an expense. So what we're going to do, we're going to record something to cash. We're going to record something to rent expense. Generally speaking, when you decide something is an expense, you just put whatever the name of it is in front of the word expense, and you got yourself the account. If we're paying for rent, it's rent expense. If we're using up supplies, it's supply expense, and so on. Okay, so as a result of paying rent for the month, let's deal with cash first. Is cash getting bigger or is cash getting smaller? Are we increasing cash or decreasing cash?
Decreasing.
We're decreasing because we're going to write a check to the landlord. And after we write that check, we're going to have less cash in our bank account. As a result of paying for our rent for the month, is rent expense getting bigger or is rent expense getting smaller?
Here.
Yeah, it's getting bigger. When we incur expenses, when we're paying for something and we record it as an expense, that is going to be an increase to rent expense. Okay, let's translate that into a journal entry. Which account needs to be debited? Cash or rent expense? Let's think about this. We need to make rent expense bigger. We need to make cash smaller.
Rent expense.
Yeah, rent expense, because rent expense normally has a debit balance. We need to make rent expense bigger, so we're going to debit rent expense. Cash is an asset. Assets are made smaller by crediting, which is what we need to do, so we're going to credit cash. So the journal entry that we would make here would be to, down a row, the journal entry that we would make here would be to debit rent expense for the amount of rent paid and credit cash for the same amount to decrease cash. Okay, D, we're rendering more services, but we're doing it for cash this time. So what accounts are involved when we render services and we're paid on the spot?
Cash.
Cash and what else? What do we always record when we deliver services or deliver goods to a customer?
Revenue.
Get some revenue. So what's happening to cash? Is cash increased or decreased as a result of rendering service for cash?
Increase.
It's going to increase. Customer is going to give us cash or give us a check. So our cash balance goes up. Is service revenue getting bigger or smaller?
Bigger.
It's getting bigger. When we sell goods or services, we record revenue, and that's going to make our revenue account get bigger. Okay, so given that we're increasing cash, what do we need to do to cash? Do we debit it or do we credit it?
Debit.
We need to debit it to make it bigger. And service revenue, we also need to make bigger. How do we make service revenue get bigger?
Credit.
We credit it because revenue is one of those accounts that normally has a credit balance. So if we are increasing service revenue, that requires a credit to service revenue. Okay, E. One thing you'll see as we do is when you start doing these problems, a lot of times you'll get a second transaction that's related to something that was previously recorded. This is an example of that. So in E, we receive the amount due from the client in B. So back in B, we provided services to a customer. The customer promised to pay us later. We recorded accounts receivable and service revenue. When we get down to E, we receive a check in the mail from the customer. The customer pays us. So what accounts are going to be changed as a result of the transaction that's described in E?
Accounts receivable and cash.
Accounts receivable and cash. What's happening to accounts receivable? Is it increased or decreased?
Decrease.
Decreased, because when a customer pays us, they no longer owe us money. So we are going to decrease the amount that's receivable from the customer. What's happening to cash? Is it increasing or decreasing?
Increase.
It's going to increase because when somebody sends us money, cash goes up. So what's our journal entry look like?
Cash is debit.
Yep, cash is going to be debited or whatever the amount of the payment is from the customer. Because cash is an asset. Assets are made bigger by debiting, and accounts receivable is also an asset. And we know that accounts receivable needs to be made smaller. So we are going to credit accounts receivable. And anywhere along the way, if something doesn't make sense, stop me and ask a question. F, we purchased a desk on account. So what accounts are going to be changed by buying a desk on account? Well, first of all, what does buying on account mean? Let's clarify that. What does that mean if you buy something on account?
Is that an expense?
It will be eventually, not yet though.
You'll have to pay for that later.
Yeah, it means you're promising to pay later. So this is the opposite situation of the accounts receivable. With accounts receivable, you're selling things and promising, then the customer is promising to pay you later. When you buy something on account, you're the customer now and you're the one making the promise to pay somebody later. So what accounts are going to be involved if we buy something on account? We're buying something today and promising to pay for it later. Well, what would we call the desk? What do you think? What do you think the desk gets classified as on our balance sheet?
Asset.
It's going to be an
Asset.
asset. And in particular, it would go into an equipment account, is what we call stuff like desks and equipment, or desks and computers and things like that. Are we increasing or decreasing our equipment account?
Increase.
We need to increase it because we now have a desk we didn't used to have. So equipment needs to be increased. And what do we call a promise to pay a vendor later for something that we're buying today? We've seen this account a couple of times already. It's going to be the mirror image of an account receivable. The seller records an account receivable. The buyer records an account payable. So do we need to increase or decrease our accounts payable as a result of this transaction?
Increase.
We need to increase it because we owe somebody money. So accounts payable is going to be increased. Okay, so given that equipment is an asset, what do we do to equipment to make it bigger?
Debit.
We need to debit equipment. And accounts payable, what kind of account is accounts payable?
Liability.
Liability, and
Credit.
we need to credit that since it's a liability to make it get bigger. So again, an abbreviation I'm going to start using. Accounts receivable are always known as AR. Accounts payable are always known as AP. So we need to credit our accounts payable for whatever the amount of the desk purchased is. Okay, G, comes time to pay the employees for the month. What accounts are involved when we pay the employees for the month?
Expense. Wage expense.
Yeah, I've got an expense. And remember the key, the thing when you have an expense, generally speaking, just put the name of the item in front of the word expense and you've got the account. So this would be salaries expense. And what else do we have besides salaries expense? What's the other half of the transaction? What are we paying them with?
Asset.
An asset. And what kind of asset do we pay our employees with?
Cash.
Cash. So we've got cash and we've got salaries expense. What's happening to cash? Is it increased or decreased?
Increase. Decrease.
Decreased, because we're going to write a bunch of paychecks to our employees. When our employees cash their paychecks, our cash balance is going to go down. And what are we doing to salaries expense? Do we need to make that bigger or smaller?
Bigger.
Bigger, because when we're incurring cost, expenses are increasing. And remember the rule here, remember we said a few minutes ago, when you pay for something, you either record an expense or an asset. So when we pay for salaries, that's classified as an expense because the employees have already done the work for the period, so that we've used up their efforts of their labor. So we're paying for something that's already been used. So it's an expense rather than an asset. All right, so what do we need to do to cash when we do the journal entry? We need to decrease cash. How do we decrease cash?
Debit.
Going to be a credit, right? Because cash is an asset and cash is made bigger with debits, made smaller with credits. So cash, we're going to credit. The normal balance of an asset is a debit balance. So to make it smaller, we need to credit it. And expenses, if we go back to our cheat sheet, we see that expenses normally have a debit balance. So if we need to make salaries expense bigger, then we need to debit salaries expense. Okay, H, got another follow-up question. So in H, we bought a desk, promised to pay for it later. The bill has come due, we pay the bill. So what accounts are going to be changed as a result of paying for the desk that we bought on credit?
Cash and accounts payable.
Cash and accounts payable. What's happening to cash? Is it getting bigger or smaller?
Smaller.
That's gonna be
Smaller.
smaller, so we need to decrease cash. What's happening to accounts payable? Is it getting bigger or smaller?
Smaller, right?
Also smaller, because accounts payable is a liability. So when we pay our bill, we no longer have a liability. So we need to decrease accounts payable. So what do we need to do to accounts payable to decrease accounts payable? Here's our rules. What do we do to accounts payable to make accounts payable smaller?
Debit.
We would debit it.
Debit.
because yeah, accounts payable is a liability, which means it normally has a credit balance. So to make it smaller, we are going to debit it. So that didn't require a debit to accounts payable. And cash is an asset. Cash is made smaller when we credit it. So we are going to credit cash for the amount of the payment. Okay, so that's how I highly recommend when you start doing problems that you have to record journal entries for. I would highly recommend going through that thought process to come up with the journal entry. Analyze the transaction, figure out what the accounts are, number one. Number two, figure out are the accounts that I've identified made bigger or smaller as a result of the transaction? And then once you've got that straight in your head, what the accounts are they made bigger or smaller? Then use your rules for what normally has debit balances, what normally has credit balances, and figure the journal entry out from that. Early on, when you're learning this stuff, if you look at this transaction and immediately start thinking debits and credits, chances of making a mistake are pretty high. If you go through it methodically and use that three-step process, your odds of getting the journal entry correct are a lot higher. There's rules. It's a very methodical process. When you get good at this stuff, you can kind of look at the world and think about it in terms of debits and credits, but most people don't get to that point right away. So you have to go through step by step. Okay. Any questions about anything, any of those before we move on? Okay, let me look. I think I'm just going to do one of these two problems. They're somewhat repetitive. Actually, I guess they do something a little different. Okay, actually, let's look at both of them. Okay, so the next one we're going to do is exercise 2.6b. So what we're doing in 2.6b is we're going to record some transactions, and we're going to do it two ways. First thing we're going to do it is in the context of the accounting equation to show what accounts are being made bigger or smaller, and then we'll translate those into a journal entry. So we've got a bunch of transactions. So what we've got a company called Final Clean, a company that provides house cleaning services. And they're a brand new company, which means the beginning balances and all of these accounts are zero. With an existing company, you'd have some beginning balances to deal with. To make life simple, we're going to assume new company. So we start with zero. And then we've got a bunch of transactions that occurred during the month of April, and we need to record the transactions. So what we're going to do, we're going to record the transactions two ways. We're going to do it in the context of the accounting equation. The stuff in blue are the assets, stuff in red are liabilities, stuff in green are equity. And concept that we're going to introduce here is that expenses and revenues are expenses and revenues that show up on the income statement, but they also affect stockholders' equity. The link between the income statement and the balance sheet is a stockholders' equity account. And the way it works is revenues make equity bigger, expenses make equity smaller, and then dividends make equity smaller. So we're going to look at the impact on stockholders' equity for revenues, expenses, and dividends. Okay, so I'm going to have to do a little flipping back and forth on this one. I don't have the transactions written out, so let's take a look at them. So the first transaction is Randy Smith invests $14,000 in cash to begin the business. He received common stock for his investment. So from the business's perspective, what accounts are involved here? Randy Smith, who's the owner of the business, gives the company $14,000 to start up, and Randy Smith gets common stock in return for his $14,000. What accounts are involved there?
Cash
Cash
and common stock.
Common stock. So what we're going to do, we got $14,000 worth of money being invested. So what we're going to do, we're going to put 14,000 in here for cash. We're going to increase cash by 14,000. And we are going to increase common stock by the same amount. Okay, notice that when we're done, we have an accounting equation that's still in balance. We have $14,000 of assets, and we have $14,000 of liabilities and equity. We don't have any liabilities yet, but we have $14,000 of equity. So the accounting equation balances. Second thing we need to do, we need to record a journal entry for this. So cash was increased by 14,000. What do we do to cash to increase cash? Cash going to be debited or credited?
Debit.
Debit.
You need to debit cash. And that's going to be for 14,000. And common stock is an equity account. Common stock is made bigger when it is credited. So we are going to credit common stock for $14,000. Okay, second transaction. In addition to, actually, just jumping ahead here. So the second transaction, April 2, paid 6 months lease on a van for $2,850. So what accounts are going to be affected if we pay for a 6-month lease on a van?
Asset.
Got an asset? What asset in particular?
Uh,
Is it cash?
Yeah, actually, yeah, we got cash is going to be involved. And actually, I got a second asset involved. Anybody want to take a stab at what the second asset is? This is going to be an example of it's going to be, so our rule is, remember when we pay for something, if it's used up right away, it's an expense. If it's used up down the road, it's an asset. So is paying for a 6 months lease on a van going to be an expense or an asset for the business? It's going to be an asset. The general rule is if it's used up within a month, it's just going to be an expense. If it's going to be used up more than a month from now, we're going to record it as an asset. So we're going to have an asset on the lease on the van. So 2850, what we're going to do, we are going to, is cash getting bigger or smaller as a result of this transaction?
smaller.
Smaller, because we are going to write a $2,850 check to the leasing company. And what we're going to record that 2850 as, we're going to record it as an asset. We are going to record that as an increase to an account that we're going to call prepaid van lease. PPD is abbreviation for prepaid. So we're going to have an increase to prepaid van lease. Because the thought process here is we now have the right to use that van for the next 6 months. That's an asset to our business. All right, we use the van to deliver stuff or whatever we're using the van for. So our business is made better. We're going to get economic benefit from the van. So after we do that, the accounting equation is still in balance. We've still got $14,000 of assets because one asset went up, one asset went down. So the accounting equation still balances. Okay, given that both of them are assets, what are we debiting here? Cash or van lease?
Credit?
Well, which one is being debited? Are we debiting cash or are we debiting van lease? Which one gets the debit?
Van lease.
And the van lease, because we need to make the van lease bigger. Both of them are assets, and assets are made bigger when they're debited. So we are going to debit the van lease for $2,850. Cash, we need to make smaller. Cash is an asset. Assets get smaller when they are debited or credited, excuse me. So we're going to credit cash $2,850. Important thing to note here, when you use debits and credits, there are never negative debits or negative credits. They always are represented by positive numbers. So what we're doing, remember, if you think about the thought process here, cash is being made smaller. The way that we make cash smaller is we credit it. So crediting cash is effectively decreasing cash by $2,850, but that's not shown by a negative $2,850 as a credit. It's just shown as a $2,850 credit. Okay, on April 3rd, Randy goes out and borrows some money from a bank, $10,000, signs a note payable, agreeing to repay the $10,000 in 1 year plus 10% interest. So what accounts are involved when we borrow money from a bank?
Liability.
We have a liability in the form of a note payable. What else is involved?
Cash?
Cash. So cash and note payable. So let's go to our spreadsheet. Is cash getting bigger or smaller as a result of
Bigger.
borrowing money? Yeah, the reason we borrow money is to get cash. So cash is increasing. And what's happening to our note payable? Is it getting bigger or smaller?
Bigger.
It's getting bigger because we now owe a bank $10,000. So we need to increase our liabilities by $10,000. So after we record that transaction, accounting equation still balances. We have $24,000 in assets. We have $10,000 in liabilities, and we have $14,000 of equity. So we've got $24,000 on both sides of the accounting equation. Okay, let's turn this into journal. Let's turn this into debits and credits. What are we doing to cash?
Debit.
We need a debit cash to make it bigger. And notes payable is a liability. Notes payable is credited to make it get bigger. So we are going to debit cash for 10,000, and we are going to credit notes payable for 10,000. On the 3rd, we also bought some cleaning equipment. So this one's going to be our first of many journal entries. It's going to be a little bit different than the ones we've seen so far. So we bought $5,500 of cleaning equipment. We paid for 2,000 of it right now, and we promised to pay the rest within 30 days. All right, so what accounts are involved in this transaction? Bought equipment, paid for some of it right now with cash, promised to pay for the rest of it later. Actually, 3 things in this transaction. So everything we've done up to this point has involved 2 accounts. This one's going to involve 3. So what things are involved in this transaction?
Cash.
Cash is going to be involved because we're told that $2,000 was paid up front. What else are we going to have?
Payable.
Got a payable because we're promising to pay the balance later. And then what's the third piece? What are we getting? What are
Equipment.
getting some equipment? So we've got equipment, we've got cash, and we've got accounts payable. So let's go back. So what's happening to cash? Is cash getting bigger or smaller?
Smaller.
Smaller, because we are writing a $2,000 check to our equipment vendor. What's happening to equipment? Is it getting bigger or smaller?
Bigger.
Bigger. And was it 5,000 or 5,500? 5,500. So we're going to increase equipment by 5,500. And what about our accounts payable, getting bigger or smaller?
Bigger.
Bigger, because we owe $3,500 to our equipment vendor. So we bought 5,500 in equipment. We paid for 2,000 of it up front. So we are going to record accounts payable of 3,500. Okay, so let's turn this to our first 3-parter for the journal entry. So what are we going to do to cash? Are we debiting or crediting cash?
Crediting. We
need to credit cash. So cash gets credited for 2,000. And again, the reason, if you look at this later, I'll put this spreadsheet up on Canvas after we're done. The reason I'm doing minus the cell instead of equal the cell is I need to change the sign from a positive to or from a negative to a positive, because debits and credits are always positive numbers. So if you look at this later and see that some of them have equals and some of them have minuses, the reason it's a minus is just to change the sign of the number. What are we doing with Equipment, debiting or crediting.
Debit.
Need to debit equipment to make it bigger. So equipment is going to be debited for 5,500. And what are we doing to accounts payable? We need to increase accounts payable 3,500. How do we increase accounts payable?
Credit.
We need to credit it because accounts payable is a liability. They normally has a credit balance. So things that normally have a credit balance are going to be made bigger with a credit. Okay, and you'll see this is going to be a common theme on all these spreadsheets that I do this semester. If you can't figure out where a number comes from, where that number come from, click on the number, and a lot of times you can look and see, and it'll show you where the number came from. If I got the number from somewhere else, instead of typing the number in, I'll put a cell reference. So this $14,000 comes from cell K5. So you click on the number. If I pulled it from somewhere else, you'll see where the number came from. And once again, the accounting equation is still in balance. Oops, actually not in balance. What do we do wrong here? Oh, I'm missing a total. It should be there. Okay, the accounting equation is now in balance. If that thing was a thing. Well, for some reason that keeps coming up. That says 13,500 now. So we got 27.5 in assets, 13.5 in liabilities, 14,000 in equity. Okay, April 4th, we bought some cleaning supplies for 4,300 in cash. What accounts are involved when we buy cleaning supplies for cash?
Cash.
Cash, and what else?
And supplies.
And supplies. So we've got cash and supplies. What's happening to cash? It's getting bigger or smaller?
Smaller.
Getting smaller because we are writing a check to our cleaning supply vendor. And supplies getting bigger or smaller?
Bigger.
Bigger. So we will increase supplies. How do we translate that into a journal entry? Make cash bigger, make cash smaller, make supplies bigger. What are we going to do down here?
Cash gonna be credit.
Yep, we're going to credit cash. Okay, important distinction here. Why did we use supplies instead of supply expense? Why are we debiting supplies when we buy the supplies instead of debiting supply expense? When do supplies become supply expense?
Debit.
Yeah, they would be debited when they're supply expense, but when do supplies become supplies expense? What makes supplies become supplies expense rather than supplies?
When they're used.
When they're used up. So when we buy them, we put them on the books as supplies, and then down the road when the supplies get used up, then we'll convert supplies into supplies expense. All right, on April 7th, We paid $350 for some advertisements to run during April. What are we going to, what accounts are involved there? Want to get our business. Cash is going to be involved.
And expense.
Yeah, it's going to be an expense. In this case, advertising expense. So 350. So what's happening to cash? Is it getting bigger or smaller?
Smaller.
Smaller, because we're paying for advertising, so cash is going to get smaller. And then advertising expense, what's happening to advertising expense? Is it getting bigger or smaller?
Bigger.
It's getting bigger. Okay, here's something that's confusing. Using this accounting equation model is a great tool for understanding this stuff, but there's one thing that's confusing about it. When you have expenses and you're doing it in this accounting equation model, expenses always get shown as negative numbers because the effect of expenses is that they decrease equity. So when we have expenses, the expense account's getting bigger by $350, but when an expense account gets bigger by $350, the effect on equity is it makes equity get $350 smaller. So that's why I'm showing this as a negative number, even though we've increased our expenses. When you use this accounting equation model to show this stuff, it has to show up as a negative number. So a little bit of a departure from everything else we've been doing. Okay, so we need to decrease cash by 350. We need to increase advertising expenses by 350. So how do we do that in a journal entry? Decrease cash, increase expenses.
Cash gonna be credit.
Yep, cash is going to be credited. So we'll credit cash by 350 to decrease it. And if we go back to our debit and credit rules, expenses are one of those things that normally have a debit balance. So we need a debit advertising expense to make advertising expense bigger. Okay, we jump ahead to April 21st. We billed customers for services to the tune of $3,500. What accounts are involved there when we bill customers for services that we provided to them?
Revenue.
Yeah, we're going to have revenue. Anytime you deliver goods or services to a customer, you have revenue. And what else are we going to record?
And cash.
Not cash, because it says we billed them for services. So that tells us that they haven't paid us yet. So what do we have when a customer has gotten something from us, but they haven't paid us for it yet?
Receivable.
We have a receivable. So we've got accounts receivable and we have revenue. So what's happening to our accounts receivable as a result of the transaction? Is it getting bigger or smaller?
Bigger.
Bigger, because customers owe us $3,500. So we increase receivables by $3,500. And when we sell things to customers, revenue gets bigger. So we increase revenue. Revenue shows up in this model as a positive number because revenue makes equity bigger. So anytime you have revenue, the impact on equity is to make equity bigger. Once again, the accounting equation is still in balance. There's our total assets. There's our total liabilities. There's our total equity. When you add liabilities and equity together, they equal total assets. And how do we translate making accounts receivable bigger, and making revenue bigger in a journal entry. What do we need to do?
Receivable gonna be credit.
Actually going to be debited because accounts receivable are an asset and we're making our asset bigger. So receivables are going to be debited for 3,500. And if you look at your list of accounts, revenue is one of the accounts that's made bigger with a credit. So we would credit service revenue for 3,500. On the 23rd, we paid $1,500 on account for the cleaning equipment. So this cleaning equipment that we bought back on the 3rd, or on the 3rd, we paid $2,000 down. We agreed to pay the remaining $3,500 later. We are paying $1,500 on the account today. So what accounts are changed as a result of paying $1,500 on account? What accounts change when we make a payment?
Cash
Cash is going to change.
and equipment.
The equipment's already been recorded, so we don't do that a second time. But we do change one of the other accounts related to that transaction. So here's the original transaction on the 3rd. So the other thing that's going to change is the payable, the account payable. We have paid off part of what we owe to our vendor. So we are going to decrease cash by 1,500. We are going to decrease our accounts payable by 1,500. We're writing a check which decreases cash. We're paying off part of our obligation which decreases accounts payable. So how do we translate that into a journal entry? We're decreasing cash, we're decreasing accounts payable.
Cash.
Yep. What do we do to cash to make it smaller?
Yep. Credit.
We need to credit it. So credit cash, 1,500. And accounts payable is a liability. Accounts payable are made smaller with debits. So we are going to debit accounts payable for $1,500. Okay, on the 28th, we collected $2,300 from customers on account.
Cash.
That's going to be cash and it's going to be accounts receivable. I'm going to speed these along a little bit. We're starting to run out of time. So if we collect 2,300 from customers on account, we are going to increase cash by 2,300. And we are going to decrease accounts receivable by the same amount. Because we're receiving cash from customers, which makes cash go up. They no longer owe us money, so that makes accounts receivable go down. So what we're going to do to record that, we're going to debit cash. We're going to credit accounts receivable. So we're going to do equal to 2,300 debit to cash, and then a credit for 2,300 to accounts receivable. On the 29th, Randy receives a $1,000 cash dividend. He's the owner of the business. What accounts are involved when the company pays a dividend to its owner or owners?
Cash.
Cash is going to be involved. What's the other account that's going to be involved?
Expense.
It seems like an expense, but transactions with the owner are treated differently. When you have a payment to an owner of the business, it's going to be a dividend. And dividends are not expenses. They look like an expense, walk like an expense, but they're considered to be different because they're a transaction with an owner rather than with a third party. So we've got $1,000 for cash and for dividends. So what's happening to cash when we record the transaction? Is it getting bigger or smaller?
Smaller.
Smaller, because we're going to write a $1,000 check to Randy Smith. And then dividends, like I said, look like an expense, act like an expense, but they're different than an expense. But the effect on equity is the same. We are going to increase dividends by $1,000 as a result of this transaction. But when you increase dividends, the impact of increasing dividends is to decrease equity. So it shows up in this model as a negative number, but dividends are actually being increased in this case. So the journal entry to record this, dividends are one of the accounts that get bigger when they're debited. So we're going to debit dividends for 1,000, and cash needs to be made smaller. So we are going to debit cash or debit dividends for 1,000 and then credit cash for 1,000. On the 30th, we paid wages of $1,750 to our employees. What accounts are used when we pay wages to the employees?
Cash.
Cash. And what's the other half of the transaction?
Salary expense.
Salary expense. So when we write checks to employees, cash goes down. And when we pay salaries to the employees, wage expense, salaries expense, the same thing. Wage expense is increasing, but again, expenses make equity smaller, so it shows up as a negative number. And wage expenses needs to be made bigger. Expenses are made bigger when you debit them. So we are going to debit wage expense. And we are going to credit cash because cash is getting smaller when we write out a bunch of paychecks. So credit cash $1,750. And then last transaction of the month, we paid a service station for gas used during the month of April, $350. What are we going to record there? What accounts are involved?
Pay cash.
Going to have some cash. And what are we going to, what's the other half of the transaction to record gasoline used during the month?
Expense.
It's going to be an expense, and we'll call it gasoline expense or gas expense. So cash decreases by $350. And fuel expense is increased by $350, but because it's an expense, we have to show it as a negative number because it makes equity smaller. So we're going to increase fuel expense, decrease cash. Expenses are made bigger when you debit them. So we're going to debit fuel expense. Cash is made smaller when you credit it. So we credit cash for $350. All right, so recorded a bunch of transactions using journal entries, and we've also done it using the accounting equation model. You'll notice the accounting equation is still balanced when we're done. 26,050 of assets, 12,000 of liabilities, plus 14,050 of equity equals 26,050. So When you record transactions properly, the accounting equation stays in balance. Okay, questions about anything I did on that problem? Again, I'll put these up in that problem solutions folder on Canvas so you can look at this later if you want to go back and refer to it.
Yeah, excuse me, sir. So
Yes.
what's the homework for today?
So the homework is on My Business course. So when you go onto My Business course in the home section, you'll see a link for the chapter 2 assignment. It'll go live after we're done with class today. It's not available yet, but it'll be available after class. Click on that. And the way the homework works is you'll get 3 attempts to get it right. So when you put the answer in and you say submit, it'll tell you right or wrong. It'll give you a green check mark if it's right or a red X if it's wrong. You get 3 attempts at it, and then you're out of attempts on the homework. So, think carefully before you submit. It's not an unlimited number of submissions to put in until you get the right number.
Oh, so you mean if I'm wrong, I can't change the answer, right?
Well, you can change it twice. You get 3 attempts. So you can get it wrong 2 times, but the third one is the one that counts.
Okay.
Okay. So, and the homework problems will look similar to these. These will look similar to you when you do the homework. Okay, last one we're going to do is 212, and I'm going to show you one other thing that we do when we record transactions. And we're going to introduce T accounts and the trial balance. So very similar problem to what we just did. We've got a new business with a bunch of transactions, but instead of recording them using the accounting equation and journal entries, we're going to record these with journal entries and then put them in T accounts. And then at the end of the month, we will do a trial balance to make sure that everything balances. So we've got a person starting up a law practice. I mean, you'll see these transactions are very similar to the ones we just did. So we start the month off by putting $18,000, the owner puts $18,000 of cash in the business. He receives common stock for his investment. So $18,000 investment by the owner. So what we're going to do in this transaction, we're running out of time, so I'm just going to speed through these, is we are going to have a debit to cash because the business now has cash that it didn't have before. And we are going to credit common stock for the amount of the investment. Cash is increased, common stock is increased. So we debit cash, we credit common stock. So we're debiting cash for 18,000 and we're crediting common stock for the same amount. So what we're going to do in this problem, this mirrors what we're going to do more throughout the rest of the semester. We're going to record things first with a journal entry. And then the second thing that we need to do is we need to update the T account for that item. So when we recorded the investment by the owner, we're debiting cash 18, we're crediting common stock for 18. We're going to go down to our T accounts and we're going to do the same thing to the T account for each one of those 2 accounts. We're going to put $18,000 in as a debit for cash. We're going to put $18,000 in as a credit to common stock. And remember our rule, debit means on the left, credit means on the right. So left side for the debit, right side for the credit. Second transaction we had, we bought some office equipment on account for $14,000. So we need to change cash, we need to change office equipment. So we are going to debit office equipment, which is an asset, because we've acquired office equipment that we didn't have before. So that's being made bigger. And we're paying for it with cash. So that's being made smaller. So we need to debit office equipment for $14,000 to increase office equipment. We need to credit cash for $14,000 to decrease cash. So we'll do it once with the journal entry up here, debiting and crediting. And then we will go down to I'm sorry, I did the wrong account. It's not cash. I should have read the problem more carefully. We bought it on account. So it is accounts payable. And accounts payable needs to be made bigger because we now owe somebody $14,000. So we're going to credit accounts payable because it's a liability to make it bigger. So we will do it once with the journal entry up here, debit office equipment, credit accounts payable, and then we'll replicate that with our T accounts. We will make an entry to the left side of equipment to debit equipment, and we will make an entry on the right side of the notes payable account for $14,000. Okay, number 3, we purchased or paid office rent for October, $700. So when we pay rent, we're going to change cash, we're going to change rent expense. And what we need to do here, we need to increase rent expense because we've incurred an expense. So we need to make that bigger. Expenses get bigger when they're debited. And we're paying for it using cash. We need to make cash smaller, so we credit cash. And that's $700 worth. So we record the journal entry up here, debit, rent, expense, credit, cash. And then we do the same thing down here. We credit cash for $700 and we debit rent expense for $700. Okay, something to point out here. The reason that we use these T accounts in addition to the journal entries is so we can keep track, we can keep a running balance of what's in the account. The way that you find the balance for a T account is you add up all of the debits and you add up all of the credits. You subtract the smaller total from the bigger total. So with cash, we've got $18,000 of debits. We have $700 of credits. Combine the two, and the net result is a $17,300 balance. Each T account either has a debit balance or a credit balance. You don't add up all the debits and all the credits and put both of them at the bottom. You combine them together, you net them together. It's like combining positive and negative numbers. If we had a positive 18,000 and we combined it with a negative 700, we'd have a positive 17,300. So purpose of these T accounts is to keep track of the balances. Okay, the fourth transaction, we paid $12,500 to access an online legal database for 2 years. So what we've got here is a decrease to cash because we're paying for something with cash, and we have an increase to a prepaid legal database because we have the right to use this database for 2 years. So we are going to debit prepaid legal database. We are going to credit cash. And the amount that we paid was $12,500. So cash is credited $12,500 and legal database is debited for $12,500. On the 5th, we billed clients for services rendered $11,300. So when you deliver services, that's revenue. If you're billing them, that's accounts receivable. We need to make accounts receivable bigger. So we're going to debit accounts receivable. And we also need to make service revenue bigger. We will credit service revenue. We're billing them for $11,300. So we debit receivables 11.3, credit service revenue 11.3. Same thing happens with the T accounts. Accounts receivable is debited. And legal fees earned is credited. Let me change that to legal fees earned. Legal fees earned is just what they call revenue at the law firm, but it's the same thing as service revenue. Okay, 6th transaction, we made a $6,000 payment on account for the equipment purchased on October 2nd. So when we make a payment on account, we are going to decrease the account and we're going to decrease cash. When we purchased the equipment, so this problem actually told us to use notes payable instead of accounts payable, so I'm going to change that. So notes payable is going to be made smaller. Notes payable is made smaller when you debit it because it is a liability. And cash is being made smaller by crediting because it's an asset. So we made a $6,000 payment. Transaction number 7, we paid a legal assistant's salary, $3,100. So we've got some wage expense, we've got some cash. And wage expense is going to be our salaries expense. In this case, is getting bigger. Expenses get bigger when you debit them. Cash is being made smaller. Cash gets smaller when you credit it. So $3,100 to salaries expense, $3,100 credited to cash. So cash is credited $3,100, salaries expense is debited $3,100. Eighth transaction, we collected $9,400 from clients previously billed from services. So when we collect money from customers that have already been billed, we have accounts receivable and cash. Cash is getting bigger. So we debit cash for the amount received, $9,400. Accounts receivable is getting smaller because if customers pay us, they no longer owe us money. So we need to decrease the receivable. So cash is debited and accounts receivable is credited. Transaction number 9, we received an invoice for October utilities for $250. It'll be paid in November. So we're getting a bill for utilities used in October. So we need to record that as a utilities expense, but we haven't paid for it yet. So we need to record it as accounts payable. So utilities need to be made bigger. Expenses are made bigger when they are debited. So $250 debited to utilities expense. Accounts payable also needs to be made bigger. Accounts payable gets bigger when it's credited. So we credit accounts payable $250. And we can see, actually, we're going to use accrued expenses here, which is another account where we record the amounts owed to. And then finally 10, dividends paid to the stockholders, just like the last problem. When you pay a dividend, we've got dividends and we've got cash. We debit dividends to increase dividends, 1,500, yes. So we debit dividends, 1,500. And cash is being paid out, so we need to decrease cash for the same amount. Okay, so after we do that, we have done 2 things. We have recorded all the transactions using journal entries, and we have posted the journal entries to the T accounts. We've updated the account balance for whatever we've done in the journal entry. When we're done, we have ending balances for all the accounts. 3,600 in cash, 12,500 in the legal database, 1,500 in receivables, and so on. What we need to do at the end is we need to do something called a trial balance. What a trial balance is a listing of all the accounts. We list out the assets first. We list out the liability second. We list out equity third. Then we list out revenue. Then we list out expenses and then dividends at the tail end. What these are just the account balances from each of the accounts. There's my cash balance. There's my legal database balance. My equipment balance is 14,000, it's there. So we take the balance from the T account, put it in the appropriate column. If the T account has a debit balance, it goes in the debit column. If the account has a credit balance, it goes in the credit column. And we're just taking all of these accounts from the T accounts, listing them out, listing them in either the debit column or the credit column, adding them up and making sure they balance. If the accounts don't balance, you've made a mistake. You have either not posted something to a T account that should have been posted. Maybe you posted it on the wrong side of the T. Maybe you made a data entry error and entered the wrong amount. But if you've recorded journal entries correctly, you've posted them correctly, and then you've transferred the posted balance to the trial balance. Trial balance has to balance. So the trial balance is done as a double check on your work to make sure that you have recorded the transactions correctly. And on this one, it works. We've got 37,550 for debits, 37,550 for credits. Okay, questions about anything. So these are the mechanics of doing accounting. Using debits and credits, recording transactions, posting the transactions to T accounts, and then taking the T account balances and summarizing them in a trial balance. This is about 80% of the work that you do for the accounting cycle. This is a pretty big chunk of what a company does over the course of a month. You know, if you're Amazon, you take these 10 transactions and multiply them by about 1 million or many millions, and you would have the number of transactions that a company this size of Amazon has to record. Okay, so I will post the spreadsheet that I just filled out. I will post that to Canvas here when we get done. The problem should be available to you on my business course. If there's a problem with the problem, if you have questions about the problems or they don't work or whatever, email me. But that's going to be due Sunday night at 11:59 p.m. Pacific. Got 3 cracks at each problem. So you get 2 chances to make mistakes, but the 3rd attempt counts. For Friday, we're going to cover chapter 3. So take a look at the lecture on YouTube for chapter 3. And we'll do the same thing on Friday for chapter 3 that we did for chapter 2 today. We'll go over some problems and we'll answer questions. Any questions before we wrap up today? Okay, so no class tomorrow. So I'll see you again on Friday at 9:30. We will go over chapter 3. So listen to the lecture, take a look at the book to get some knowledge. What we're going to do in chapter 3 is just basically take what we did in 2, do it some more, and then add on to what we did in chapter 2. So have a good rest of your day today. If you have any questions between now and Friday, let me know. Otherwise, I'll just see you 9:30 a.m. Friday morning. Okay.
Thank you, sir.
Okay. See you later.
See you.